Hello, Assalamu alaikum students. This is your teacher, Azka, and today we are going to solve paper 1, Olevels or IGCSE accounting, paper 1, variant 1, and this is new paper, as you can see, May June 2024. So this is your multiple choice question, and you have 1 hour 15 minutes in total to solve the whole paper. Okay, so I'm going to start from here. Okay, so first of all, I have a question that William is a trader and he has received an order from James. Okay, so it means that James is the customer of William to supply goods on Garrett. Okay, so basically James is the Garrett customer. It means okay. So the question is, when should William regard the revenue as earned? Because as you can see that this is not the cash sale, this is the credit sale. So the question is that when should William regard the revenue as earned? Because he just received an order. William is just received an order that he has to supply some goods to the James. It is not revenue yet. It means that he is basically not earned yet. He is not earned yet. The supply, the goods is basically supplied maybe after confirm the order from by the Williams. William. Okay, so we know that when we should, yeah. So when we should basically record this carrot sale. So we can record this carrot sale when we deliver the goods. For that, we would not say that this is our revenue. Okay, so in A part, when William accepts the order from James, but this is only showing us the acceptance of William. It is not delivered yet. So that's why we cannot say that this line is showing us that we should record this credit sale as revenue yet. So this is wrong. In B part, when William delivers a goods to the James, yes, this is right option because if William delivers the goods to the James, so only in that condition we say that okay, this is our revenue, and we know that whenever we are delivering the goods to the customer, so only in that case we will be recording it in our prime books. When William receives full payment for the goods from James, no, it's not like that. If you are providing some goods to someone, so it means that we are having the ownership of that amount which our customer owed to us. So this is not right. And in D part, when William receives the first payment on account from James, no, it's not like that because we know that we record the carrot sale. Even we didn't receive any amount from our customer, but we even we are recording it. And if maybe you know that revenue is the part, the revenue which you are writing in the income statement. In revenue, you have two types of sales: carrot sales plus cash sales. So that's why if carrot sales suppose not to record as earned revenue, so it means that we will not be selecting this B part. So B part is right because whenever the William will be delivering the goods to the James, so it means that William has um, the ownership on that amount which James owed to the William. So B option is the right option. Okay. So now let's move forward. Yeah. So following ratios have been calculated for a trader. Okay. So what explains these changes? First of all, we have the profit margin. So year one profit margin is 15% and in year two it is 20%. So profit has increased by 5%. The return on capital employed is 9% in year one, but it is 6% in year two. So we know that what is the formula of return on capital employed? You have to write the profit before tax um, and after that you will be dividing it by the capital employed. Okay. Uh, so what explains these changes? So if you can see that profit has increased, and the return on capital employed has decreased. And we also have to multiply with 100 because we want our answer in percentage. So what explains these changes? Drawings have increased. Drawings have increased by more than profit for the year. Okay. So if drawings are basically increased, so it is not related to return on capital employed, because in the return on capital employed we are writing the profit, okay, and we are writing the capital employed. Whatever the capital employed in the business, whether this is in the form of non-current liability or whether this is invested by the owner. So if the drawings are increasing, so it is not linked with the return on capital employed and neither with the profit margin. So that's why this option is not right, because this is not related to it. And if you see in the B part, gross profit has increased, but profit for the year has decreased. So as you can see that we don't have any information related to gross profit, and if the gross profit had increased, so of course the profit would also increase. But here in this statement, they are talking about that profit for the year has decreased, but this is not the case. The profit margin has increased in this case. So B option is not the right option. Profit for the year has increased and capital has been introduced. So if you see that profit has increased, it is right, and capital has been introduced. So this answer seems to be right. Why? Because if for example, if we have the capital which maybe is equal to $1,000, let's suppose, okay, and now maybe there are some more capital introduced by the owner. Let's suppose if he introduced $10,000 or maybe $1,000 more. So now the total capital employed will be $2,000 from the owner. So now because this denominator has increased, and this is the reason that we can see the return on capital employed is decreased. It is decreased by 3%. In year one, that was 9%, but in year two, this is 6%. So it is decreased. Why it is decreased? Because more capital has introduced, and that's why your denominator is big now. Like it is a big amount now. Previously it was $1,000, but now this is 2,000. So when your denominator is increasing, so whether your profit is increasing or not increasing, but still you will be getting a lower answer, very low percentage for your return on capital employed. So it means the C option, it seems to be right option. Profit for the year has increased and a long-term loan has been repaid. So if a long-term loan has repaid, so it will decrease in your denominator. But the thing is that if the denominator is decreased, so our return on capital part would increase. But this is not the case. Again, you will see if you see the return on capital part has increased because the denominator get higher because new capital has introduced. So that's why D is not the right option. Okay. Uh, so now let's see the next question. Okay, so George provided the following information. We have these information, and his liquid assets ratio is 1.2 into 1. What was his bank overdraft? Okay, so now this is very easy. Um, we know that what is the formula for asset test ratio. So for the formula for asset test ratio is current assets minus inventory, okay, divided by current liabilities is equal to 1.2, which is basically our asset test ratio. It is 1.2. Okay, so from current assets we have to deduct, uh, if you see that the trade receivable are the current assets, Inventory is also the part of current assets, and trade payables is the current liability. And non-current asset would not be the part of this formula. Okay, so we should not record this inventory. We should record only trade receivables, because as you can see that I've deducted the inventory from the current assets. So it means that I will be writing only $18,000. Okay, so $18,000 and um, divided by current liability is equal to 1.2. So now because I want to find out the current liability, so I will shift 1.2 here. So 18,000 over 1.2 is equal to current liability. So if you just divide $18,000 with 1.2, so this is giving you the $15,000 answer. $15,000. So it means that current liability is 15,000. So if you see that this is showing us a total liability, and they're asking us to find out the bank overdraft, and we know that bank overdraft is a current liability. But now if you can see that we have the figure only for the total current liability. So if you want to find out the current liability only in the form of bank overdraft, so if you see that you have trade payables, if the total liability is 15,000, so minus 8,000 from it, so the remaining current liability would be your bank overdraft. So it means that $7,000 would be your bank overdraft. So A option is the right option. Okay. So the next question is that a trader provided the following information. Okay, so we have the cash purchases for the year, we have credit purchases for the year, we have trade payables at the year end, and now what we have to find, what was the traders trade payable turnover, okay, in days. So first of all, write the formula for this. First of all, we have to find the average trade payables. Okay, so average trade payables, um, average trade payables is basically trade payables at the year end, which is $14,000. Okay, and the total carried purchases was 1,08,000. Okay, so now we can easily find out the trade payables turnover. Is equal to total carried purchase divided by average trade payables. Okay, so total carried purchases are 108,000 divided by 14,000. So this is giving us the answer, which is 7.71 times, but we have to convert it into days. That's why we have to divide 365 with 7.71 times, and you have the answer, which is 47.34 days, and approximately we can say that this is 48 days. Okay. So D option is the right option. So now move forward. What is needed for the preparation of the statement of affairs? Okay. So for statement of affairs, we know that this is for the incomplete records, and they are not basically maintaining the double entry system. So of course, they don't need the trial balance because they are not preparing the trial balance, nor the income statement, nor the books of entry, time entry, because of course they are not recording the their transactions like the other businesses. So they only need the value of assets and liabilities. So D option is the right option. Okay. So the number 30 question is that we have to find out the revenue for the year. So business uses 20% markup to arrive as at its selling prices. Okay. During the year, it made purchases of 35,000 and the inventory decreased from 7,000 to 2,000. So what was the revenue for the year? Okay. Um, so first of all, we have to find out um, the cost of sales because we don't have the information related to cost of sales. So first of all, we have to find out the cost of sales. So cost of sales is equal to just give me one second. Okay. So we have to find out the cost of goods sold. So for that, how we can find it out? Purchases plus decrease in inventory. Okay, so purchases is basically $35,000 and your inventory has decreased from $7,000 minus 2,000. So it means that your new inventory value is 5,000. So 35,000 plus 5,000. So you have $40,000 as a cost of sales. Okay. So since the business uses a 20% markup, 20% markup. Okay. So it means the selling price revenue is 120% of the cost of goods sold because we know that markup always apply on the cost of sales. Okay. So if the markup is 20%, so it means that markup is 20% means that your GP is 20% of cost of sales. So if let's suppose if we just taking an example, you have different other formulas to convert this, but I'm just want to take an easy step here. So we don't know that what is the revenue, and we know that the cost of sales. Yeah. Okay. So we know that the cost of sales is 20%, and the GP is 100. Let's suppose if this is 100. Okay. So now how we can find out the revenue? You just need to add GP with the cost of sales. So you will be finding out the revenue, and revenue will be 120%. So it means that we can easily find out that because since business uses a 20% markup, so the selling price is 120% of the cost of goods sold. So that's why we will be multiplying the cost of goods sold with the 120%. So if you want to find out the revenue, so you have the cost of sales multiply 120%, but you have to convert this 120% in the um, in points. So it means that it will 1.20 multiply 40,000 and 40,000 multiply 1.20. So we have 48,000 revenue. So the correct answer is 48,000. Okay. So what is the direct cost for a manufacturer? Okay, so this is very easy. We know that if you know the basic format of the manufacturing account. So you know that direct cost means that direct labor is also a part of direct cost. We can easily trace um, this cost. We can easily spread this cost on the number of units which is produced by the manufacturer. And there is direct labor, direct material is also direct cost means direct labor and direct material. And also there is one more cost which is royalties. It means that these are the expenses, these are the costs which you incurred to prepare the product. So if you see that royalties are here, the option production royalties. And what are royalties basically? For example, if you have to, if you are maybe preparing good and you have to patent your design, or if you just want to have a copyright, um, uh, if you just want to have a copyright, so it means that you have to incur some expenses because this expense is only done for a product. So this would be the part of direct cost. So that's why D option is the right option. Okay, we know that the depreciation of delivery vehicle is not a part of direct cost, it is a part of indirect cost. This is also indirect cost, and this is also indirect cost. So D option is the right option. Okay, 28. Um okay. So at the end of the financial year, okay. So at the end of the financial year, a manufacturing business owed rent on its factory. Okay. So it means that if rent owed to its factory, so this is current liability. The business adjusted its financial statements to account for this. What effect did this adjustment have? So we know that rent of factory would not be the part of prime cost, so that's why there is no effect. Cost of production, your cost of production would increase. Why? Because we know uh, that first of all you have to prepare the manufacturing account. So in manufacturing account you have to see the material cost, like all the direct cost plus all indirect cost. You have to add this, and after that you will be recording this in the income statement, and in the section of trading, like in the trading section of income statement, you will be writing the total cost of production. So that's why um, rent on factory would be the part of indirect cost. That's why it would also be the part of cost of production. So it would increase. Okay. So what will happen to the gross profit? So we know that in the gross profit, your gross profit would decrease. Why? Because if the cost of sales are increasing, because you are putting the cost of production into it, so if the cost of sales are increasing, so your GP would decrease. So that's why gross profit would decrease. So B option is the right option. Which accounting statement prepared by the treasurer of sports club provided a summary of all the monies received and paid out during the financial year? So this is a very easy. For the normal business, we prepare the cash book, and for the club accounts, we prepare the receipt and payment accounts. Okay. So AB Sports Club runs a cafe for the use of members. Treasurer prepared a draft financial statements which showed a deficit of $700 and an accumulated fund of 4,600. We then discovered the closing inventory of the cafe had been overvalued by $50. So how much were the deficit and the accumulated fund after the inventory valuation had been corrected? Okay. So first of all, what is the deficit? So original deficit is $700. So this is the original deficit. And the overvalued inventory is equal to $50. Okay. So if we want to correct the deficit, so since you overvalued the closing inventory with $50, and now you are going to decrease the closing inventory with $50. So it means that if the closing inventory will decrease, so it means that your cost of sales would increase, and if the cost of sales increase, so it means that your GP would decrease and your deficit would also increase. So that's why we have to add the $50 in the 700. Okay. So because the overvaluation reduce the expenses and increasing the deficit. That's why. So now your original, so this is basically 750. Okay. So now your accumulated fund, which is 4600. So now you have to deduct the 750 because now your deficit has increased. So it means that 4550 would be your accumulated fund. So because increased deficit reduces the accumulated fund. So this is your new accumulated fund. Okay. So it means that C option is the right option. Which apply to both debentures and preference shares. Okay. No voting rights. Yes, they don't have voting rights. Fixed rate of return, yes. Included in capital employed, yes, this is true. Because debenture is the part of your non-current liability. So in capital employed, we add the preference shares and also the debentures. But if you see the other answers are wrong. Uh, no voting rights, they cross this option, and it means that they are saying that debentures and the preference shareholders has the voting rights. And fixed rate of return, and they are crossing it, it means that they are saying that they don't have the fixed rate of return. So it's not like that. So all options are wrong, only A option is right. Okay, so we have the next question. A company supplied the following information, and what is the total equity we have to find. So this is very easy. The finding or the total activity, what we have to do. So we just need to add the issued and paid up share capital. This is the part of equity, and the general is also the part of your active equity and your retained earnings. This is also the part of the total equity. So $30,000, $45,000, and $35,000, and it is giving you the answer. Okay, which is 33,80,000. The C option is the right option. Okay, so now we have to see this question. Rajat and Sony. Okay, so we have question number 23 that Rajat and Sunil formed a partnership on 1st January 2019 but did not prepare a partnership agreement. They provided the following information. Okay, so capital introduced on 1st January 2019. Rajat had invested 40,000 and Sunil invested 20,000. During the year ended 31st December 2019, drawings were taken by the Rajat, which is 5,000, and by Sunil, this is 3,500. Share of work is 50-50%. They decided to draw up a partnership agreement for the future years. Which item would be the most beneficial to Rajat in 2020? Okay. So for Rajat, if you see the drawings are 5,000, which is higher than Sunil, and but the capital reduced is higher than Sunil for the Rajat. So a partnership appropriation account is basically an account that shows how the profit or loss of the partnership is distributed among. Uh, this is the question. Okay. So since Rajat and Sunil didn't have a partnership agreement, so they defaulted to the partnership pact, which typically doesn't provide for interest on capital, drawings, or salaries. So to benefit Rajat in 2020, the most advantageous item would be the interest on capital. This is because Rajat contributed more capital, which is $40,000 than Sunil. By including interest on capital in the partnership agreement, Rajat would receive a higher return on his investment, and it is reflecting his larger contribution to the partnership. So this provision would benefit Rajat more than the others, as it would recognize his greater capital contribution and provide a higher return. So that's why A option is the right option. So what is shown in a partnership appropriation account? Okay. So capital contributed by each partner, distribution of profit and loss among the partners, partners' current account balances, and interest on the partner's loan account. So basically, partnership appropriation account is an account that shows how the profit and loss or loss of the partnership is distributed among the partners. So it typically includes profit or loss for the period, interest on capital, salaries or partnership salaries, okay, distribution of profit or loss among partners according to their profit sharing ratio. So this account is prepared after the profit or loss has been calculated in the profit and loss account, and it shows how the profit or loss is allocated to each partner. So the uh, it means that your option B is seems to be the right option. The other options are wrong, A, C, and D, because it is not correct because capital contributor each partner is shown in the partner's capital account. And if we talk about a C, which is partner's current account balances, so it is shown in the partner's current account, and interest on partner's loan account is shown in the partner's loan account. So that's why these option is not the right option. Okay. So question number 21. Okay. So a trader was preparing her statement of financial position at 30 June 2021, and she had four bank loans. Okay, so these are the four bank. What was the total amount of loans that should be recorded as non-current liability at 30 June 2021? Okay. Uh, so if you see that this the date repayable is written, so this 5,000 would be repayable in first December 2021. So we are preparing um, the statement of financial position at 30 June 2021. So because this amount would be payable in December, so this would not be the part of non-current liability. So only these three would be the part of non-current liability because these are repayable after 1 year. This is repayable in 2022, 2023, and 2025. So 10,000, 8,000, and 6,000. So it is giving you the answer, which is 24,000. This is the right option. Which business is not a service business? So accountant's practice, this is also the service business. Computer repair shop, this is the service business. Flower shop, this is not the service business because you are selling a product, not giving a service. Hairdressing salon, This is also a service business. So C option is the right option. Okay. So after that, at the end of the financial year, Cindy values her inventory at cost. Okay, so at the end of the financial year, Cindy valued her inventory at cost. This valuation incorrectly included the damaged goods costing $300. Okay, Cindy estimated these goods could be sold for $100. What is the effect of correcting the inventory valuation? Okay, so initially inventory was overvalued by $300 as we can see. So it is included in the damaged goods. But however, these goods can only be sold for only $100. So the correct value is 200, less than the initial valuation, which is 300. So correcting, if we correct the inventory valuation, so it means that decrease the value of inventory, decrease the value of inventory by $200. So it means that your current assets are decreasing by $200. So this seems to be the right option. And decrease the cost of goods sold, because if the uh, inventory is decreasing, the valuation of inventory is decreasing, so it means that it is also decreasing your cost of sales. So if your cost of sales are decreasing by $200, so it means that, because since the damaged goods are no longer used, so decrease the cost of goods sold by $200, so it means that your gross profit, um, yeah. So because if you see that it's because decrease in the gross profit, since the cost of goods sold is also decreasing, so that's why your gross profit will also decrease by $200. Okay, and also if the gross profit is decreasing by 200, so your profit is also will also decrease by $200. So that's why your current assets, your profit for the year, and your gross profit all will be decreasing. So A option would be the right option. Okay. So the next one, that why is inventory valued at a lower cost and net realizable value? So basically, inventory is valued at a lower of cost and net realizable value to follow the accounting principle of prudence, which requires you to avoid the overstatement of assets and profits and recognizing the losses as soon as possible. So valuing inventory at a lower cost in NRV ensures that if inventory is damaged, obsolete, or its market value drops, so the loss is recognized immediately by valuing it at NRV. And profit is not overstated due to inflated inventory values. And current assets, it means the inventory are not overstated, providing a more accurate financial position. So it means that B option is the right option to avoid the overstating profit and the current assets. Okay. So after that, question number 17. Uh, why does a trader maintain a provision for doubtful debts? To ensure amounts owing to the business for which payment is unlikely to be received as regarded as an expense. Yes, this is right. We maintain the provision only for this reason also, so that we can know that what would be the amount of doubtful debts, so that we can treat it like as an expense. To ensure the trade receivable of the business are not overstated by providing the debts which is unlikely to be paid. Um, so this is also right, because of course if we are not maintaining the provision for doubtful debt, so it means that we are overstating our trade receivables, because if some amount, you know that it is maybe not paid after a certain time, and still you are writing your trade receivable, you are not maintaining the provision for doubtful debt account, so it means that you are overstating your trade receivable. This is also right. To identify correct customer. Okay, so we know that provision for doubtful debt is not used for identifying any customer, so this is not right. To provide the to provide for the amounts from credit customer which are unpaid at the end of the financial year, no, it's not right. We basically prepare this before the ending year. So 1 and 2 is right. So A option is the right option. Okay. So Mandeep depreciates its motor vehicle at the rate of 20% using the SLM. A full year's depreciation is provided for in the year of purchase. Mandeep bought a motor vehicle on 1st January 2017 for 2020. On 1st June 2020, he bought a second motor vehicle for $10,000. Uh, what was the depreciation charge on the motor vehicles for the year ended 31st December 2020? Okay, so now just see that they asked to find a depreciation charge. They are not asking us to find out the accumulated depreciation. It means that we should only find out the depreciation for year ended 2020. So it means that first of all, for vehicle one, your total cost is 20,000. Multiply it with the 20%, so it would give you 4,000. And your second vehicle is $10,000. Its cost is 10,000. Multiply 20%. So this is giving you the answer, which is 2,000. So for 2020, your depreciation would be 4,000 and 2,000 is equal to 6,000. So this is straight line method. So we know that in 2017, its depreciation would be 2,000, 4,000 for vehicle one. In 2019, it is similar, and in 2020, it is similar. But because we need to find out a depreciation charge only for the 2020, so that's why we only have to write 4,000, not 12,000. Okay, the following ledger account appeared in the books of traders. Which entry was made in the income statement for the year ended 31st December 2020 for rent receivable? Okay. Um, so we know that this is a rent receivable account. It means that this is our income account. And for income account, we use a mnemonic which is A, B, B, A. So this balance CD is showing us the prepaid amount. Okay. And this balance CD is showing us also the prepaid amount. So yeah. So now what we have to do is, first of all, we have to recall its basic format. So its income statement will be coming here, because at the year end rest receivable account would be debit and your income statement would be credit. Um, so that's why just first of all add 400 with $3,600. So it will give you $4,000 in total. And now multiply 4,000, 4,000 minus 600. So you have 3,400. So 3,400 you will be sending to the income statement. 3,400 credit. So A option is the right option. Samir runs a car hire business. He received a cash payment for car hire. He also received the proceeds from the sale of an old vehicle. What type of receipts were they? Car hire. So car hire is basically his business. So if he is receiving any cash payment for car hire, so it means that that would be his revenue expenditure or revenue receipt. So that's why this option will be right. And if you see that he received proceed from sale of an old vehicle, which maybe he is using for his business, so it means that that would be the part of capital expenditure, capital receipt, sorry. So that's why this option is the right option. C option is the right option. Okay. uh, Nadia provided the following information for the month of July. Okay, so first July serial control account balance debit is 1750 and current balance is 215. So first of all, I think we should prepare the account here. So balance BD and balance BD. 750 on debit side. On current side, this is 215. Okay. So for the month of July, total sales journal would be 5500. So we know that sales, this is basically our sale ledger control account. So sales is would be recorded on the debit side. So sales 55. Check received from Carrot customers, which is 4840. So this would be the part of Carrot side. Okay. Irrecoverable debt written off, which is 280. Okay, so I just skipped this part. Total sales return journal. So this is a sales return, so this will record here. Sales return debit and sales ledger control account debit. This is 360. And irrecoverable debt, bad debts. Bad debts debit and sales ledger control account debit. 280. Interest charge on the credit account. So if we are charging interest, so it will record here on the debit side. So the control account debit and interest charge will be carried because this would be a kind of income for us. Interest charged, which is $5. Okay. So if it is total it, so this is 7255, and now deduct basically your credit side is less than your debit side. So that's why if you deduct all these amounts, so you will be having your balance CD, which is 1560. So this will be transferring here balance PD 1560. So they are asking us to find out a debit balance on brought down on sale at the control account on 1st August. So this is the transaction for July. So it means that the next month would be the August month. So this option is a right option. Okay. What would not be included in the sale area control account? Okay, so cash is recorded in the cash book. Um, okay, so we know that it is recorded in the cash book. It is not recorded in the sale area control account. Checks received from that customer recorded in the cash book. Yes, it recorded in the cash book, but it also before that it recorded in the sale area control account. Goods sold on credit recorded in the sales journal. First of all, it is recorded in the sales journal, and after that, it will be recorded in the sales control account. A recoverable debt written off recorded in the journal. It is firstly recorded in the journal because journal is the prime book, but after that, it will record in the sale ledger control account too. So what would be not recorded in the sale ledger control account, which is cash sales? So A option is the right option. Okay. So question number 11. On 31st May, the bank statement of business showed a positive bank balance, which is 1790. Comparing the bank statement with the cash book, the following items were discovered. Bank had charged $35 in error and passenger checks total, which is 550. Uncarried deposit, which is total 250. So what was the cash book balance? Okay. So 1790 is the original amount first. Okay. So bank charged $35 in error. So we add this back to the balance. Is this because this is not uh, deducted by the cash book. That's why we have to add back $35. So this is 1825. Okay, so unpresented checks means that cash book has recorded payments, but they haven't cleared by the bank. So that's why we have to subtract it. And unpresented checks are 550. So this is giving you the answer, which is 1275. So now if you see the uncarried deposit, which is $250. So uncarried deposit means that the cash book has recorded receipt, but the bank has not yet credited. That's why we have to add this 250. So this is why our answer would be 1525. That would be the cash book balance. So C option is the right option. A business has received a bank statement. Bank statement shows the following entries. Okay. Okay. Check issued to the credit supplier. Business has received which item appear in the debit column of the bank statement. Okay. So check issued to a credit supplier. So this would be um because we know the things which we are debiting, the bank are crediting it. Bank is crediting it, and the things which we are debiting, bank would be credited because business, whenever if there is a inflow of cash, so it will increase the cash book. Okay, and whenever there is an outflow of cash, so this would decrease the cash book. But whenever there is an inflowing of cash, for example, if you are depositing, if someone is depositing money into your bank, and even if you're depositing the money in your bank, so it is debit for you, but it will be credit for the bank, because for the bank the liability has increasing, because of course bank has to pay you this amount after a certain time whenever you want to withdraw. So bank has to pay that amount to you. So whenever your bank is increasing, this would be increasing the liability for the bank, and whenever you are crediting, this would be debit for the bank because it is decreasing the liability for the bank. So okay, so which item appears in the debit column of the bank statement? So check issued to a credit supplier, so we will be credited but the bank would debit it. So this is the right option. A check received from the credit customer, so we will debit it but bank will credit it. But they're asking us to find they're asking us the items which appear in the debit column, so that's why this is not right. Monthly rent payment made by the standing order, so we are credited but the bank is debited, that this is also right. Charges made by the bank, so we will be uh, uh, credited but bank will be debited, so that's why 4, 2 and 1 is the right option. A is the right option. Okay. uh, Question number 9. Payment of $68 for insurance has been entered in the insurance account as $86. So it means that we have increased this by $18. It should record 68, but we increase. So we know that insurance account would be debit whenever it is increasing. But now because we have to decrease it by $18, so that's why we have to credit the insurance account. So we will be credit the insurance account, and in the debit side there is nothing. So it means that where there is nothing, there would be suspense account. So suspense account would be debit and insurance account would be credit. So C option is the right option. Okay. Okay. So the next person, 8%, Trevor prepared his financial statement for the year ended 31st December 2020. He then discovered that he had omitted to record a cash payment, which is $240 for insurance for the 12 months ending 30 November 2021. So, what was the effect of this error on his statement of financial position? So, he is preparing this for 31st December, and this payment 240 for insurance for the 12 months ending on 30 November 2021. So, what would be the effect on cash, other receivables, and the capital? So, cash is overstated by 240. Why? Because the payment was not recorded. That's why. So, these two options seems to be right. So, other receivables, which is prepaid insurance, because this insurance covering the 12 months. So that's why this would be the other receivable. So because this is a prepaid insurance, so it is understated by 220, um, because the payment was for the period ending for 30 November 2021. Okay, so 220, it means that only for 10 months of the prepaid insurance relate to the next financial year. That's why would be um, it is understated by 220. Okay, and if we talk about the capital, so it is overstated by $20 because the expense was not recorded. So the net profit was overstated by $20 because 2 months worth of insurance expense. So it means that it is overstated by $20. So it means that B option is the right option because the payment was for 12 months ending on 30 November 2021. Okay, but only 2 months because in December 2020 and January 2021 relate to the financial year ended on 31st November 2020. So the remaining 10 months relate to the next financial year. Okay. Question number 7. Which statement about a trial balance is correct? It is a list of ledger balances on particular date. Yes. It is a part of double entry system of bookkeeping. No. This is not a part of double entry system. And it is a proof that all items have been posted to the correct account. It's not sure because we know that sometimes, not sometimes, most probably, if you did this expense account, so you get to know that in trial balance, it is not a guarantee that whatever it is a proof that all items have been posted to the correct accounts. Maybe there are some kind of errors also involved in it. It is proof that all transactions have been entered in the bank books of account. Again, this is not sure because in trial balance, there are a lot of mistakes we did in different books of account. And because of that, our trial balance would not be balancing. And that's why we have to prepare the suspense account. So this is also not right. So A option is the right option. Okay. Question number 6. That a trader has the following ledger account. Okay. So what does the balance on first January through year 2 present? So this is they're talking about this year 2 January 1st balance. So this is a heat and light account. It means that this is our expense account. And for expense account, we use a mnemonic P A. So if balance BD is there, so it means this is showing us a prepaid expense. So uh, 1 second. Okay. So if the balance BD is here, so it is showing us that is accrued balance because balance CD would be there, which is accrued, and now that would be shifting towards here in form of balance BD. So this is accrued. So it means that your heat and light expense are outstanding. So A option is the right option. Which business accounts are not entered in the books of prime entry? Okay, not entered. Credit note entered in the returns journal, like return inward or outward. Debit note has no existence. Invoice would record in the sales journal. Statement of account would also, this is not um, not record in any books of prime entry. This is just a reminder for your customer that you owed us this specific amount. So this would not record. So debit note and statement of account would not record in any book of prime entry. So it means that 2 and 4, B option is the right option. Okay. So analysis column of a petty cash book show the following totals. So we have $20 in postage and stationery. We have 31. So how should these totals be posted to the ledger? Okay. So this is a very simple because this is the expense accounts posted and stationery. So we should debit the postage account by $20 and stationery account by 31. So this is very simple. The option is the right option. In which book of the prime entry does a trader record cash discount receipt? Okay. So we know that whenever you are receiving a cash discount, so you will be recording this first of all in the cash book. It will not record here. Which statement is correct? Accounting involves measuring losses and profit. Yes, this is right. Accounting is recording of financial transactions. No. Bookkeeping is all about recording transactions. Bookkeeping involves communication financial data. No, because bookkeeper only need to record the financial transactions, not communicating the financial data. This is the function of accountant. Bookkeeping requires a use of ratio analysis. No, in bookkeeping we don't use the ratio analysis. We only record the transactions. So A option is the right option. Which task is performed by a bookkeeper? Analyzing accounting ratios? No. Interpreting the income statement? No. Uh, Posting entries from the journals to a ledger? Yes. Preparing a statement of financial position? No. This is the function of accountant. Uh, this is also the function of accountant. This is also the function of accountant. This is also the function of accountant. Only recording the day-to-day expenses and preparing ledgers would be the part of bookkeeper. Part of like it would be the this function would be the part of bookkeeper. Okay. So we have completed this paper. But still, if you have any question related to any, and if you have related any query related to any specific question, you can just comment under comment section, and I will be replying you.